Welcome to another episode of Stock Battle. In this episode, we are going to witness an epic battle between two giant energy companies, Chevron versus ExxonMobil. Before we begin, please note that everything in this video is for only entertainment and informational purposes and does not constitute investment advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Let the battle commence. Despite a global push for renewable energy, fossil fuels remain the dominant energy source. In the United States, for example, oil and natural gas accounted for 74% of energy consumption in 2023, while renewables made up only 9%, according to recent statistics. Furthermore, the U.S. Energy Information Administration reports that crude oil production has consistently risen in recent years, indicating that the demand for traditional fuels is far from waning. This demand is further amplified by the recent artificial intelligence boom, which requires massive amounts of electricity for the construction and operation of new data centers. Major oil and gas producers like Chevron and ExxonMobil stand to benefit significantly from these rising energy demands. As two of the world's largest companies in the sector by market capitalization, their strong and diversified operational portfolios position them perfectly to satisfy the world's continued appetite for energy. Before we continue, please remember to like this video if you want to see more content like this in the future. Also, subscribe to our channel and check out other video series down in the description below. Let us continue. The operation of an oil and gas company consists of two major segments, upstream and downstream. The upstream segment is at the start of the oil and gas value chain. It consists of exploration, development, production, and transportation of crude oil and natural gas. The downstream segment is at the end of the value chain, closest to the consumer. This segment consists of refining, marketing, and distribution of crude oil and natural gas into finished products. With this understanding in mind, let's look at Chevron and ExxonMobil performance in each segment based on the most recent earnings report. In the second quarter of 2025, ExxonMobil significantly outperformed Chevron in both two segments. In the upstream segment, Chevron reported a profit of $2.7 billion, while ExxonMobil's profit was $5.4 billion. In the downstream segment, Chevron reported a profit of $737 million, while ExxonMobil earned $2.4 billion, which was more than 3 times Chevron's earnings. On the other hand, looking at the balance sheets at the end of the second quarter of 2025, ExxonMobil is the winner in most categories. ExxonMobil has significantly higher total assets and total current assets than Chevron. Even though ExxonMobil holds more debt in absolute terms, the difference in total debt is less pronounced than the difference in asset size. Finally, ExxonMobil maintains a considerably lower net debt-to-capital ratio at 8.0%, indicating a stronger, less leveraged financial structure compared to Chevron's 14.8%. These earnings reports indicate that ExxonMobil is in better shape than Chevron due to its ability to generate a lot more profit and a more solid balance sheet. To confirm our winner, let us head over to the website aistockpal.com and use the Stock Battle feature. We simply populate the stock tickers of the two companies and hit the button, "Let the battle begin." As we expected, the winner of the stock battle is ExxonMobil. Please head over to this website aistockpal.com to try out this feature yourself and read the analysis performed by artificial intelligence. It's important to note that investing in oil and gas companies is risky for several reasons. First, extreme price volatility in crude oil and natural gas directly impacts profitability and cash flow. This inherent risk is amplified by the global shift toward renewable energy, creating long-term demand uncertainty. Second, the sector is heavily exposed to geopolitical instability, regulatory changes, like carbon taxes, and the increasing threat of severe weather events, making earnings highly unpredictable. To mitigate the long-term risk of declining oil demand and increasing carbon regulation, both Chevron and ExxonMobil have been investing in new lower-carbon technologies. Chevron is investing over $8 billion in carbon capture projects, including the Bayou Bend carbon capture and storage hub in the U.S. ExxonMobil is aiming to be a large-scale third-party CO2 storage provider through its low-carbon solutions business. Last year, the company signed agreements to store CO2 from industrial partners like CF Industries. Overall, it is our opinion that in the short to medium term, next 5 to 10 years, there is a bull case for investing in oil and gas companies. Global energy demand, boosted by AI data centers and emerging economies, will keep prices and profits robust. Strong cash flow supports increasing dividends and buybacks. However, in the longer term, these investments become more risky due to accelerated transition to renewable energy and regulatory risk around carbon. That is the end of this episode of Stock Battle. We hope you have enjoyed this video. Please show your support by liking this video and subscribing to our channel for all future contents. Thank you for watching, and we wish you a wonderful day.